So is Rigetti Computing, ticker symbol RGTI, is it the ultimate buy the dip opportunity in the quantum computing space right now? Or, are you looking at a devastating value trap that's just like disguised as a bargain?
Right. That's the multi-billion-dollar question today.
Exactly, because we're seeing this massive disconnect in the market right now. Today is April 14th, 2026, and depending on who you ask, you're getting totally different answers on this stock.
Yeah. You have algorithmic models that are literally screaming the stock is overvalued. And then on the other side, you've got Wall Street consensus saying, no, there's actually a massive upside here.
Right, it's dividing the market completely.
Mhm.
So our mission for this deep dive is to unpack all of that. We're going to tear through the latest news, the technical analysis, the raw financials, all of it.
We've got a whole stack of financial reports and insider trading data to go through.
We do. And real quick, before we open up the hood on RGTI, make sure you like the video and subscribe to the YouTube channel. And you've got to leave us a comment with your feedback. It is basically compulsory for the algorithm at this point.
Yeah, please do. And just stepping in here for a second, we always have to say this deep dive is just a natural human debate. We're doing an educational analysis of the data. This is absolutely not financial advice.
Right, exactly. Do your own research. But okay, to figure out if this stock is a trap, I think we first have to look at the sheer scale of its recent collapse.
Oh, it's been a free fall.
A total free fall. So let's lay out the data for you. RGTI is trading right now at $15.13.
Which is, what, up a little bit today?
Yeah, it's up about 3.07% today. And if you look at the last 2 weeks, there's a recovery of roughly 13.59%. So, a little bit of green.
Right. And this is a big, but it is caught in this brutal falling knife pattern. I mean, this has been going on since late 2025.
Yeah, because it is sitting miles below its 52-week high, right? That high was $58.15.
Exactly.
Yeah.
50, down to $15. That is a massive haircut. So the overall technical sentiment right now is very neutral to bearish.
Neutral to bearish, even with the 2-week rally.
Yeah, because what we're seeing is the stock finding this temporary, mostly psychological support right around $15.
Okay, 15 is the mental floor for a lot of traders.
So like 15.00. But the actual major technical floor is a bit lower at $14.41.
1441, got it. And what about the upside? If I'm buying the dip, where am I hitting my head?
Immediate resistance is at $15.72. And then there's a really tough ceiling at $16.36.
Okay, so it's boxed in.
Completely boxed in. And the momentum indicators they're really mixed right now. The 14-day relative strength index, the RSI, is sitting at 47.8.
Which is basically dead neutral, right?
Dead neutral. It's not overbought. It's not oversold. It's just kind of floating.
Well, what about the moving averages? Because I was looking at the short-term ones, and they were actually flashing a buy signal.
They are, yeah. The 5-day simple moving average is at $14.20. Yeah. And the 20-day SMA is at $14.30. So the current price of $15.13 is above those.
Right. But, let's unpack this for a second. If you look at the long-term trend, the 200-day simple moving average is way up at $25.50.
Yeah, that 200-day SMA is basically screaming, sell.
Exactly.
Yeah.
So trying to catch this falling knife, it feels like stepping in front of a slowing freight train. Sure, it's slowing down a bit over the last 2 weeks, but if it breaks below that 1438 support level, aren't you just going to get run over?
Honestly, yes. If that 1438 level breaks, the downside risk is severe. The charts show renewed weakness, and it could easily slide back down toward the $7.50 to $10.96 range.
Wow. Dropping back to $7 or $10, that would be brutal for anyone buying right now.
It would be. And that's why technical analysis alone isn't enough here. We have to figure out what's fundamentally driving this train off the tracks.
Right. We have to look under the hood at the actual financials, the income statement, the balance sheet, all of it. And I'm just going to say it, the income statement it's rough.
It's the definition of a cash incinerator right now.
Yeah, let's talk about the massive gap between revenue and expenses. For the full year of 2025, Rigetti's total revenue was just $7.1 million.
$7 million for a publicly traded deep tech company.
Yeah. And in Q4, they only brought in $1.9 million. But here's the kicker. Their operating loss for the year was $84.7 million.
With $22.6 million of that operating loss coming just in Q4 alone.
Right, and it gets worse. The GAAP net loss for 2025 was a staggering $216.2 million.
Which shakes out to a GAAP earnings per share of negative 70 cents.
negative 70 cents a share. And their levered free cash flow for the trailing 12 months is sitting at negative 42.19 million. I mean, just to put this in perspective for anyone listening, they lost $216 million to make $7 million.
It's a tough ratio.
It's absurd. It's like spending $30 on gas to drive across town to buy a $1 candy bar. It makes absolutely no sense on paper.
On paper, looking at traditional metrics, sure. But we have to look at the balance sheet too, because that's where the silver lining is for the bulls.
Okay, show me the silver lining, because right now it looks pretty dark.
Despite that insane burn rate you just mentioned, Rigetti actually has $589.8 million in cash equivalents.
Wait, almost $600 million in cash?
Exactly. And their total debt-to-equity ratio is incredibly low. It's just 1.31%.
Oh, wow. So they're not drowning in debt. They just have a massive pile of cash that they're slowly or quickly setting on fire.
Right. The cash flow provides them with a multi-year runway. This is a deep tech company. They're funding elite physicists and custom hardware. They are supposed to be profitable today. They're capitalized to survive these massive research and development phases.
Okay, I hear that. I do. But here's where the narrative totally breaks down for me. If they have $500 million in cash and they're building this revolutionary technology and the stock is cheap at $15 compared to 58.
You'd expect them to be buying.
Yes, you'd think the insiders, the people actually running the company, would be buying up this stock hand over fist. But if we look at who is actually holding the bag right now, it's not the insiders.
No, the insider trading data is actually a massive red flag.
A huge red flag. Over the last 90 days, insider selling sits at a net negative $718,124.
And how many insider purchases were there in that same window?
Zero. Absolutely zero insider purchases. Not one executive stepped up to buy the dip.
And we should specifically mention the chief financial officer here.
Oh, yeah. In February 2026, the CFO exercised and sold 50,000 warrants.
Which is incredibly telling.
Ugh.
Warrants give you the right to buy shares at a set price. If the CFO believed the stock was heading back to $58, they'd hold. Exercising and selling them now means they're cashing out while they can.
Exactly. If the company's own CFO isn't betting on the rebound, why on earth should the average retail trader?
Well, this ties right into the order flow we're seeing. Remember we talked about buyers defending that $15 zone?
Yeah, that psychological floor.
Right. But if you look at the volume, the trading volume is actually falling as the price rises.
Okay, so what does that mean in plain English?
It's a classic bearish divergence. It means the upward price movement doesn't have real conviction behind it. Institutional money isn't stepping in to buy. It's mostly retail traders keeping it afloat.
Wow. So retail is just getting trapped here.
They get trapped because of anchoring. They pull up a chart, they see the stock used to be at $58.15, and they anchor to that number.
So they see $15 and think, oh, it's on sale.
Exactly. They assume it's a bargain. They completely ignore the heavy insider selling, the massive net losses, and the persistent share dilution that Rigetti uses to keep that cash pile so high.
Right, because when a company issues more shares to raise cash, it waters down the value of the shares you already own.
Precisely. You want a smaller piece of the pie.
So we've got falling volume, insider selling, massive dilution, and a $200 million net loss. You'd think Wall Street would agree with the bears here.
You would think so. But the analyst ratings tell a completely different, wildly optimistic story.
It's insane. The consensus rating from analysts right now is a moderate buy.
Which is wild, given the fundamentals we just covered.
Right. There are 8 buys, 3 holds, and only 1 sell rating. And the average price target they've slapped on RGTI is $31.70.
That's a huge jump from $15.
It's a potential 109% upside. And the high target is even crazier. It's at $43. But, and this is where the debate really heats up, if you look at a valuation platform like AlphaSpread.
Oh, the algorithmic models are brutal on this one.
Brutal. AlphaSpread estimates Rigetti's intrinsic value at just 40 cents.
40 cents.
40 cents, which makes it 97% overvalued based on actual cash flows. And it currently trades at 15.05 times its book value.
Which is extremely high.
Yeah, for context, the average for the semiconductor industry is just 4.39 times book value. So 15 times is astronomical.
And that leads right into the whole market cap debate.
Right. Let's talk about the market cap, because Rigetti is sitting at a $5.02 billion valuation. $5 billion for a company making $7 million in revenue? I mean, how is that not just an ultimate trap?
Well, here's the counterargument. Here's why Wall Street analysts are ignoring the algorithms. Traditional valuation models, like discounted cash flow, which is what alpha spread uses, they rely on projecting linear growth.
Okay, so predicting future cash based on past cash.
Exactly. But those models completely break down when you're assessing cutting-edge tech that hasn't been commercialized yet. You can't linearly project the revenues of a quantum computer because it's a binary shift.
It's either a total failure or it changes the world.
Right. Wall Street is pricing this stock like a call option on the entire future of computing. If Rigetti succeeds, they don't just get a slice of the pie, they invent a whole new bakery.
Okay, I love that analogy, but we really have to ask, what exactly is the future that Wall Street is pricing in here? And more importantly, can Rigetti actually deliver it? Let's break down the catalyst. What's the bear case, the absolute worst case scenario?
The worst case scenario is a continuation of exactly what we're seeing. Negligible revenue relative to a massive $5 billion market cap.
Right.
They keep burning cash, they keep diluting shares to replenish the bank account, and they constantly fail to meet traditional earnings expectations.
And if the stock can't clear that $16.36 resistance level on high volume, we're going to see a short-term continuation lower, right? Back to that $7 to $10 range.
Absolutely. The technicals and the current cash burn support a brutal short-term pullback.
Okay, so that's the bear case. But what about the bull case? What is the best case scenario here?
The bull case requires looking 1 to 3 years out. It relies entirely on commercialization. Like we said, they have that $500 million in cash, so bankruptcy isn't an immediate threat. They have the runway for long-term R&D.
And what are they actually building with all that R&D?
The major upcoming catalyst is the deployment of their 108-qubit system called Cepheus-1.
Cepheus-1, and why is 108 qubits such a big deal?
Right, because every stable qubit you add exponentially increases processing power. Crossing the 100-qubit threshold proves their architecture can scale. If they can make Cepheus-1 commercially viable, the upside is basically unmatched.
And we are seeing tiny little hints of that commercialization, right? They recently secured an $8.4 million contract win in India.
Yeah, and while $8 million doesn't cover their operating losses,
Not even close. It covers like a fraction of a quarter.
right, but it's proof of concept. It
Yeah.
proves that sovereign nations are willing to pay for access to this tech.
But, I mean, I have to ask you, are we really just paying a $5 billion premium today for a sci-fi concept that might take a decade to actually turn a profit?
That is the ultimate tension here. So, to synthesize the whole outlook, in the short term, you're looking at a phenomenally high risk of a pullback. The technicals are weak, the insiders are selling, and there will be immense volatility around that $15 mark.
So expect a bumpy ride.
Very bumpy. But from a long-term perspective, RGTI is a high-stakes binary bet on whether that 108-qubit system achieves commercial viability. It's an all-or-nothing play.
Wow. Okay, so that leaves us with one final, very provocative thought for you to mull over as you watch this stock trade over the coming weeks. We've talked about how traditional valuation models like discounted cash flow completely fail to measure the true worth of quantum computing companies.
Right, they just can't price it.
Exactly. But if the fundamental models we use to measure financial reality are totally broken for deep tech, how do we know what we're really looking at?
It's a leap of faith.
It is. Are we looking at the next Apple, a company that's going to define the hardware of the next 50 years?
Yeah.
Or are we looking at the next Pets.com, just a brilliantly marketed concept that burned through hundreds of millions of dollars before reality finally caught up to the hype?
That's the question every investor has to answer for themselves.
It really is. It's the ultimate mystery, and the market is trying to solve it right in front of us. Thank you for joining us on this deep dive. Keep researching, stay curious, and we'll catch you on the next one.